Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate mumbo jumbo. Today we're diving into PGIM Private Credit Fund's latest filing. I promise it's more exciting than it sounds. We'll uncover what's really going on beneath the surface, even though the report itself says nothing in the world is so irresistibly contagious as laughter and good humor. I don't think they know much about 8K filings. Told by SEC and us, they are going to continue to operate pretty much as expected. We will see if that plays out. First things first, it is important to note that this filing is for PGIM Private Credit Fund to keep selling more of its shares and also update some information for some previously registered shares. No new money, just regular paperwork to keep doing their thing. So what is this PGIM Private Credit Fund? Well, it's a company that lends money mostly to medium-sized businesses or middle market companies and wants to give investors current income and some long-term gains. They are trying to get this cash from senior secured first lien debt issuances. They expect to continue this offering as soon as possible after the date of this report. Remember, this is a best efforts offering, meaning they will try to sell as many shares as they can, but aren't obligated to sell any specific amount. Now, who is supposed to buy these shares? The fund says it's only for people who are in it for the long term with plenty of money to lose. They list specific income and net worth requirements. Generally, you need at least $70,000 income and net worth, a net worth of $250,000 income and net worth, a net worth of $250,000. But wait, there's more. If you live in some specific states, you'll need even more money or a willingness to gamble only a small portion of your assets. Now about the costs. While the fund itself doesn't charge an upfront sales fee, brokers might. These are capped at 3.5% for Class D shares and 1.5% for Class D shares. Class I shares meant for bigger investors have no such upfront fees, but there are ongoing shareholder servicing fees that eat into your returns. Class S takes 0.85% annually, Class D takes 0.25%, and Class I, again, for the big players, takes nothing. Let's look at it this way. Assuming a steady $25 share price, $10,000 invested in Class S will cost you $425 in fees over 5 years. Class I, $0. Beyond the sales fees, the fund has its own operating expenses. This year for the iShare class, we're looking at 9.53% of the assets being eaten, but they do note later they are waiving fees and or expenses. Still, it's important to note the high annual operating expenses on each class. After those fee waivers, the net expenses are a bit better with Class I shares at 7.24%, Class D at 7.59%, and Class S at 8.19%. Keep in mind those expense numbers are just estimates based on data from February. It all boils down to this. A hypothetical $10,000 investment in Class S could cost you $1,940 in expenses over 10 years. Class I is a much lower $784. Now let's get to the real meat of the matter, the financial highlights. This is where we see how the fund actually performed. These numbers are from the last few years, so they give us a sense of how things are trending. For Class I shares in 2024, net investment income was $3.17 per share compared to $2.64 the previous year. So at least it's trending up. This represents what the fund earned from its investments after deducting expenses. They also had to declare that the net realized and unrealized gains was at 0.11 compared to 0.3 the previous year, which means they made more money on investments that they sold as well as ones they still held. With both items combined, all those numbers led to a total return of 14.02% for Class I shares in 2024. And hey, all those numbers are up from 2023. It seems like this fund is hitting its stride. Speaking of the performance of investments, one red flag the fund mentions is that the portfolio turnover rate has fallen. This can be good or bad. On one hand, it means they are holding their companies for the long term, but also they aren't making that many new investments. It is important to also note they are considered an emerging growth company. So they have reduced disclosure requirements and may delay adopting new accounting standards. That means you as an investor might not get the full picture compared to investing in a more established company. No corporate analysis is complete without a deep look at the risk factors. These are a few ways you can lose money, and there are plenty to go around here. First, they are very clear that you might lose all your money. You better be aware that it will not be liquid. The report mentions that the Board of Trustees can change the company's operating policies without notice, and also that the market could get more competitive and they may not be able to source the best investments. And finally, as a BDC, they are subject to rules that could limit their investment choices. And if they fail to comply, they could lose their special tax status. Related to being a BDC, the fund must distribute at least 90% of their profits every year, or they lose their favorable tax status. This section looks at the people who make the ship run. Some key members from the investment team are Deanna Carr, Coletta, Stephen J. Collins, and others. As we wrap up, remember that there's no promise you'll be able to transfer shares. As one would expect with a highly interconnected company, it does mention potential conflicts of interest. A couple of them include the compensation arrangements could result in the fund making riskier investments, and the senior management may have obligations to other clients that are not in your best interest. The company does mention that it will attempt to act fairly with the clients, which is always good to know. State Street Bank and Trust Company keeps the assets safe. Finally, before signing off, it is important to note that Prudential values your privacy, so do check out their consumer privacy policy. The experts for the filling are PricewaterhouseCoopers LL, and the legal representation is Simpson Thatcher and Bartlett LLP and Morris Nichols Ashton Tunnel LL. Now, let's put on our analysis hats. Based on the report, PGIM private credit fund seems to be steadily growing, with positive trends in investment income and a decent total return in 24. However, you have to remember, these are unlisted assets and should be viewed as a long-term investment. One area to keep an eye on is the number of new portfolio company investments being added, which may signal slower growth. Also, the reliance on key personnel and potential conflicts of interest within the management structure should be something an investor should consider. Overall, PGIM Private Credit Fund seems to be following its stated investment strategies and policies. Thanks for watching Corporate Decoder. If you found this deep dive helpful, please hit that like button, drop a comment, and subscribe for more insights into the world of corporate finance. Until next time.